So thank you very much for coming. This is joint work that I'm presenting with Xiaoqiang Wang from Indiana Kokomo and Shiqi Wei from CSU Northridge. And this is a study about the relation between institutional ownership and legal complexity in securities class actions. The idea being that people in the academics and in the industry have recently been remarking on potential abuses in the class action system, even after the security class action reform that was passed in 2000, where essentially one can file, or there's a low cost of filing class action claims, but potentially a high benefit should they actually get settled. This is a remark by Chubb, which is an insurance company that provides coverage against class actions, among other things. But this is something that people in general are aware of, both among regulators, practitioners, and academics. So what is our contribution to this? Well, the basic idea, first of all, is that class actions are complex and important corporate events. The settlement rate for class actions has actually changed quite a bit over the years. It used to be pretty high in the 90s. You can see it's come down quite a lot in the 2010s, in the last decade, sort of consistent with this idea that since it's low cost to file class actions, it actually means that more of them get filed, and therefore proportionally fewer get settled. But still the payout per settlement, as you can see, at 47 million is quite large. And the sort of welfare effect or social optimality implications of these class actions is, let's say, ambiguous at best. Because while they can be a channel for better monitoring, of course, if there's some misbehavior on part of the firms that they're actually suing to correct, they can also simply be used to extort settlements from companies through meritless claims. And there was this reform, not in 1995, but even since then, there still has been continuing and perhaps increasing record of abusive filings in securities class actions, including this recent paper from Chicago by Kempf and Spalt that focuses exactly on this idea. So what do we do in this study? Well, we propose to create a new measure of the complexity of securities class actions using textual analysis. And that will hopefully, if it's a meaningful measure, let us actually predict whether these class actions will be settled or not, how long they will take to be settled, what the market reaction to these more or less complex securities class actions is, and whether they actually seem to sort of relate to the exploitative or extortionate function of securities class actions. In other words, do institutions that file them, law firms that is, make their filings purposely complex in order to try to encourage a company to settle. Now, the other thing that we look at is, can institutional ownership actually then mitigate the uncertainty introduced by these more complex or less complex SCA filings? Because prior work, some of which was written by me as well, actually shows that different types of institutional owners have different ability to process information, potentially being able to cut through some of this noise in maybe purposely complex class action filings. So at bottom, what we seek to ask is there an interactive effect between the complexity of the SCA filing, determined through natural language processing, and institutional ownership? So we find interesting results in pretty much all of these topics. So first of all, these machine readability scores are actually inversely related to case duration and settlement likelihood, which means that cases that are, or filings that are more complex are more likely to be settled. The less readable you make your filing, the more likely it is that the person, or sorry, the firm you file it against will actually be induced to settle. So that suggests that there is indeed room for opportunistic complexity in class actions. We're able to sort of boil this down to a single measure using principal factor analysis. And this is a measure that is sort of possesses novel information in excess of just the mere length of the filing. You may be familiar with some work on text analysis of financial disclosures, which focuses on obviously quarterly statements, but there's work that shows that really the textual analysis part is secondary to the mere size of the files by Lawford and McDonald. In our case, that doesn't seem to be so. The mere length of a filing is not a sufficient statistic. It really is the complexity of the class action that drives market reactions and outcomes in terms of settlement. And there is a significant interaction between dedicated ownership, as described by Brian Boucher's work from 1998, and complexity for this price reaction. And since there might be omitted variable bias or endogeneity in the relation between institutional ownership and likelihood of security class action filings or settlements, in other words, maybe different types of institutions are more likely to hold firms that are less vulnerable or more vulnerable to SCAs. We actually instrument for institutional ownership types using peer averages, in other words, the ownership level within the industry. Now, the channel for why institutional ownership seems to affect outcomes in terms of class actions is through liquidity. I see that somebody has raised their hand, but maybe if you enter your question in chat, that'll let us integrate it most smoothly. And hopefully we'll have a bit of time at the end for questions, unless this is a technical issue. The majority of the SCA filings are actually brought by a small subset of class action filing firms. There's 20 law firms that have filed literally more than half of the class action filings in our sample. And indeed, consistent with sort of a opportunistic interpretation, those particular filings have higher complexity and higher settlement rates. So it seems like these firms that specialize in security class actions explain some, but not all, of the interactive effect between complexity and institutional ownership. Now, where does our data come from? The Stanford Class Action Clearinghouse has the text data on the filings, and the rest comes from usual sources. We end up with about 2,600 separate class action events filed against firms that have the complaint, the ownership, and the fundamental data necessary to run the analysis. Here's a little example of the way a complaint looks. On the Stanford Class Action Clearinghouse database, all of this data is in PDF form, so it requires a substantial amount of processing to actually convert it into analyzable text and then convert that text into readability scores. And if we look at the timing of these class actions on the Stanford database, we do indeed see that there is a lot more of them more recently. So filings, as you can see, after 2014 are up drastically. And that, of course, then means that settlements are down drastically, even mechanically, but it actually looks like perhaps there's a more than mechanical event here. And dismissals are up because, according to the Stanford classification, a case is either settled if there's a payout or dismissed if there is not a payout. The machine readability scores that we use are pretty standard in the textual analysis literature. The one that I want to remark on is the last one, just the length of the words in the filing. This was one that was found to be pretty much a sufficient statistic to explain readability in financial disclosures. So it's one we'll keep an eye on and see how it relates to readability in securities class action filings. As far as summary stats, really the main point here is that our sample's not too different from CompuStat in terms of fundamental characteristics, and not too different from the Stanford class action database in terms of complexity, so it seems fairly representative. If we look at the PCA, the scree plot of all these readability measures, we do see that there is a very strong principal component with a very high eigenvalue above 4 and all the other eigenvalues below 1. So that does suggest there is a commonality to readability scores of these class action filings. So that justifies the PCA dimensionality reduction approach. And so the first model we run is just to see if these machine readability scores can predict settlement. In other words, whether a payout of any sort actually happens. We control for a bunch of stuff that's been shown to be relevant in prior literature, including measures of legal complexity, fundamental data, performance of the company that's been related to the likelihood of class actions, circuit, time, industry fixed effects. So we try to control for possible confounders. And the legal complexity index comes out of a paper in the Journal of Empirical Legal Studies by McShane that shows which particular topics of legal complexity relate to settlement. So what we want to produce is a measure of readability complexity that is separate from legal complexity. And indeed, so when we do a probit model with or without controls, in the columns 1 through 7 without, 8 through 14 with, we see that for most of the scores, in fact, for I suppose all of them, there is a significant relation, including for the principal component sort of representative score of all of them. You can see that the Flesch reading index is inverse, but that's actually intentional because the reading ease index, FRE, is actually positively related to readability and therefore negatively related to complexity. But the basic idea is the more complex you make your filing, the more likely it is to be settled. So that sort of justifies the basic idea here that this readability measure does seem to have economic significance in that it can actually predict the outcome of a security class action filing before it actually happens, often well before. These cases take years to actually become settled, but just based on that first initial complaint and its text readability, we can actually make a statistically significant prediction of what the outcome will be. If we look at a linear model of duration, how long it takes for the case to either be settled or dismissed, here again we see significance, and again, all of the scores that are positively related to complexity, ARI, SI, FDG, GF, word count, and the principal component, all of these are positively related to duration. So cases that are more complex take longer to actually reach a final decision. And this is with or without controls. If we look at market reactions, generally, of course, we would expect SCA filings to be bad news, but this is a process that, first of all, has multiple second-order effects. It's not just settlement, but also disruptions to relationships, distress, and whatnot. And it's a long process. So we look at both short-term and long-term windows. And we look at drift, which is sort of like a post-earnings announcement drift measure, except in this case, it's a post-filing one. And we looked at the variance ratio. That's sort of a measure of the informativeness of prices after the effect. Generally, we see that for readability, there's a significant difference in the informativeness of prices, and more readable filings have a higher variance ratio. In other words, the more readable the filing, the more informative the prices after it's been released, less readable otherwise. For long-term and dedicated institutional ownership, we see that there's actually statistically significant differences in the drift, that if there is below median ownership relative to above median ownership, the drift is actually more negative. So in other words, the higher the level of institutional ownership by long-term types, the more favorable the market reaction is. But these are, of course, univariate tests, so let's actually then put in controls and look at a interactive effect in a multivariate setting. With a multivariate setting, we see when we look at the post-announcement drift, the price reaction, we see that for dedicated ownership in the last quarter interacted with the principal component of readability for the filing at the 60-day window, the 100-day window, and the 151-day window. We see that in the fourth a positive effect. So in other words, the more complex the filing and higher the dedicated institutional ownership, the more positive the effect on market reaction is. So really, it seems like dedicated ownership really kicks in only around complex filings. If we look at the variance ratio, we see a similar effect, though interestingly, this one is for the long-term institutional ownership only. So that for the 10-day, 60-day, and 100-day windows, we see that for firms facing more complex class action filings, but with higher long-term ownership, prices are more informed. Let's skip the marginal effect plot since they only have about a minute left. We see that the relative quoted spread as a measure of liquidity is lower, both for long-term and dedicated ownership. We repeat the same approach with an instrumented version of dedicated long-term ownership and see similar results. So that's sort of our endogeneity test, or sorry, our attempt to control for endogeneity in institutional ownership. And when we look at the frequency of filings, we see that most of them, literally over 50%, come from 20 firms. So when we count these number of frequent filer firms, we see that, first of all, the complexity of the filing is higher the more of them are involved, and the likelihood of settlement is greater the more of them are involved as well. And when we throw them into a regression of post-announcement drift, we see the results are a little weaker. Same for the variance ratio, but the results are still big. So at bottom, what we're able to say is that machine readability is an informative measure of complexity. This is a measure separate from legal complexity, since we control for that as a separate control variable. Long-term institutions can help parse the uncertainty in these complaints, especially the more complex ones. And this seems to come through a channel of improved liquidity. So thank you all for listening. Now I believe our discussant